And with your retirement income accounts, even if you invest in the stock of a regulated investment company, a mutual fund, it would not be considered within the context of the retirement income account. It would not be considered a true custodial account within the meaning of 403(b)(7 of the Internal Revenue Code, which means if there is an excess contribution, it would not be subject to the Section 4973 excise tax.
Is there anything else unique in the regulations about retirement income accounts?
Well, yes, there is a very, very interesting provision that I personally have never seen in any other type of regulation. What happened with retirement income accounts is it was not unusual for them to be set up as trusts. But there was a challenge as to what in the Internal Revenue Code allowed that trust to be currently not subject to taxation on incremental growth. What made this trust tax exempt? We know that if we're dealing with a qualified plan, it links to Section 501A of the Internal Revenue Code, which says that the trust attached to that plan is tax exempt. But in retirement income accounts, this wasn't the case. So what we did in the regulations is we went ahead and we granted tax-exempt status to any trust associated with a retirement income account for a church described under Section 403(b)(9).
Bob, when we first started our discussion, you said that one of the most significant pieces of this regulatory package goes beyond 403(b)s. Can you expand on that?
Yes, and that is the portion of the regulatory package that deals with Section 414C of the Internal Revenue Code. 414C is a section of the Internal Revenue Code that allows us to determine actually who the employer is. For example, in what we call a controlled group instance, we really want to know if you have associated organizations A, B, C, and D, are they really one employer? Why? When you get into benefits purposes, you do many, many forms of testing. You test for limitation compliance, you test for non-discrimination requirements, you test mathematically in some instances. So you really have to know who that employer is for the benefits purposes. What we have done here in this regulatory package, and this is where folks who perhaps don't even have a 403(b), aren't interested in 403(b), must take note. This is extremely important because what we have done here in this regulation under 414C is for the first time opine in a regulation in published guidance as to what the Internal Revenue Service considers to be a control group in a tax-exempt environment. For many years, Bernice, there were those practitioners who maintained that you couldn't have a control group in a tax-exempt environment because the rules under the Internal Revenue Code were essentially stock-based, and there was no stock in these tax-exempt environments. Yet what this regulation does, and I call it Control Group Light because it's a very basic and simple test, which we'll discuss in a moment, but what they do is tell us what is a control group or who is the employer for a tax-exempt organization for all benefits purposes. This is highly significant because this is not merely a tax-exempt organization described in 501c3 for 403(b) purposes. This could be a 501c6 organization, a 501c9 organization. And what this does is address all benefits purposes, even beyond your 403(b), even beyond your qualified plan. It would address any benefit circumstance such as group term life insurance, health insurance, where it's important to determine who the employer is. Now, before we talk about the actual test, it's very significant to note that this rule does not apply to governments or to what we call steeple churches and their controlled organizations. Remember, churches are divided into two groups. Steeple churches, defined in Section 3121W of the Internal Revenue Code, and your expanded definition of church, where you find a great deal of church health care, elder care, as described in 414E of the Code. But this rule under control groups does not apply to the steeple churches, the steeples only, and their control groups as described in 3121W, and to governments. Let's take a moment and look at the test. It's a very, very simple test. It's based upon an 80% director-trustee common control test. Do the directors, trustees who run these tax-exempt organizations essentially overlap on an 80% basis as described in the regulation to see if we really have a commonly controlled group? The regulation also contains a provision that allows tax-exempt organizations that share a common exempt purpose to go ahead and actually create a controlled group if they share that common purpose, if it would otherwise be helpful to them.
Bob, how can we learn more about the final regulations?
Well, I would suggest if you want to learn more about the final regulations, you would visit the IRS website at www.irs.gov/EP for further resources available on the final regulations, plus other 403B products. The best place to start is with the Navigator, which is the first topic on the Plan Sponsor Employer segment page. In the Navigator's 403B plan path, you will find publications such as the 403B Plan Checklist, which is a one-page list of common mistakes of plan errors found in 403B plans.
Bob, I want to thank you for the excellent presentation that you've made today.
Thank you, Bernice.
And I also want to thank you for joining us.